Okay, we're going to switch over now. We're going to switch over to our financial planning topic, the financial 15. And let me change let's see how this is going to work. I think this is going to work better if I'm down at the bottom left here. But the topic is how to get this zero tax. The objective, zero tax, or as close as possible. Not everybody can get the zero tax, but many, many people can. You just have to identify the roadblocks and figure out how to handle it. Today, we're going to talk about part one, Roth IRAs and Roth retirement plans. So let me just we're going to use a little bit of a example here. So many of you have met these folks before. This is an example. Just as we kind of build this out, I wanted, this is a real world example of a client we worked with many years ago and where they started. We've made some adjustments along the way, given different changes in the tax code. But at the time, these aren't their real names, obviously, but John and Mary, they're 61 and 60 years old. They want to retire at 66 and 65. Their current income is $160,000. What they need to spend, all these things are important to know, of course. What they need to spend is $84,000 a year, $7,000 a month. That, of course, is after tax, right? That's the money that they need to spend. They're expecting about $43,000 at their full retirement age. That's something that's higher now. They want to buy a condo at about age 66 when they retire at $175,000. We have so many clients looking to do this. They're looking all over the country. They're trying to, Florida has become expensive for insurance reasons and things like that, and even the cost of properties. But that's a really common goal. And so is this, by the way. They want to give some kind of gift to help their kids. And at this point, they're saying at about age 70, $25,000. And here are their investments as they stand. They have $1 million in an IRA. They have $350,000 in a taxable account, right? So that's anything outside of an IRA, not a traditional IRA or not a Roth IRA, not a traditional 401k or a Roth 401k or retirement plan. So that's what lives outside of that. John has a 401k and he contributes 10% of his income, but he gets no match. And they have some term life insurance and some long-term care insurance. So what's the goal here? Okay, get John and Mary to zero if possible. And if we can do that, we want to see what the net effect is. So what I'm showing you here is an example of our before and after comparison, because I like to show this first because this is a lot of work. It's a lot to take in. Oftentimes it's a lot of relearning. We've learned kind of the wrong way for 40 years. Now we have to revisit this and learn how to do things all over again, save in Roth IRAs, convert to Roth IRAs. If life insurance is part of your plan, all these steps, and it can take a lot of work. So you've got to be incentivized, right? So what's the incentive? I get it. Zero tax sounds good, but what does it mean from a dollar point of view? So here's what it meant for John and Sally. You'll see here, I'm just going to briefly explain this to you. Strategy 1, taxes double. Taxes double and you do nothing. Strategy 2, taxes stay the same and you do nothing. Strategy 3, taxes double, but you take steps to be tax efficient. So let's look at it. So at about, we'll see the age down there, but about age, about 86 or 87 years old, they're at risk of running out of money. Now, this is not financial planning. This is just a side-by-side comparison. All investment and inflation assumptions are the same in each strategy, so it all runs along the same. But they're at risk of running out of money. If taxes stay the same, which we all know can happen, we expect taxes to double by around year 2030. There's, again, some good videos to explain that. I'm not going to go over it today. But even if taxes don't double, there's still a significant difference between zero and at age 100, this is $2.2 million. So that's a good incentive to me. For me as a planner, if I can help a client have $2.2 million at age 100 that they could pass to their heirs or they could spend during their lifetime, well, that's a win. That's worth all this work. Now, this is net worth, right? So this is before tax. We do focus on wealth to heirs. And this is essentially an after-tax number, so that's good. They're still at zero here at age 100. Well, actually, they're at potentially zero in their 80s here, between 80 and 90. But they're still, if they're tax efficient, if taxes double and they do things a little differently to be tax efficient, then they're at $2.2 million. Now, I'm going through this quickly only because it's a lot of information. I don't want to spend a lot of time on it. But now I want to just touch on age 100 because people say, well, wait a minute, Mark, age 100, that's a long time away. I don't want to wait till age 100 to see a benefit of this. And I don't know if I'm going to be here. I don't know if I'm going to know or care. So we want to look at different times. So I'm going to just zero in on a few different numbers here for you. So what this is showing is the projected amount using a very, very simple comparison. Again, not financial planning, just a very simple comparison at age 85. So is everybody with me at this age 85? So at age 85, John and Sally are spending $170,000 a year. They haven't run out of money yet, but they potentially do here where it's red. And all they have then is really their Social Security. So let's look over here at these different numbers here. So what this shows is that before tax, that John and Sally have about $2.4 million if they're tax efficient. If from an after-tax number, they're at 2.63. Now, why is that different? Because they're able to use life insurance, and there's a little bit of death benefit here. And again, I know this is confusing, but what I want to compare is these two, because this is an after-tax, before tax number, but before life insurance, and it's pretty spot on. So at age 85, let me just make this section bigger for you. The difference to them is just about $2 million. $2 million. So what does that mean? This is the money, if taxes double and they do nothing, what they're likely to have left at age 85. Most of us believe that one of you, if you're a spouse or maybe even yourself, that one of you is going to be here at age 85. They might not believe age 100, but most people are comfortable with age 85. So you have to ask yourself, if you have the potential just by doing things a little bit differently, not taking more investment risk, not spending less money, you'll see over here, we're spending the same amounts of money for John and Sally all the time along. And I know there's a lot going on here, and I'm going through it quickly because I don't want to take the time away from the Roth conversation with this. But if you just take away from this snapshot here, that if John and Sally do things a little bit differently, they've got $2.4 million to spend rather than $478,000. And of course it gets better because at what would that be? That's age 88. This one here. This is when they're at zero. Zero is no good compared to $2.4 million. So now we're at plus $2.4 million. And that's either $2.4 million they can pass to their kids. It would actually be more than that. It would be $2.5 million because, again, if they're able to use insurance, there's a death benefit involved there. Death benefit. Hope I'm not cutting us off. If not, they can spend it. What can they spend it on? Well, anything that they want. They can spend it on long-term care if they need it. They can spend it on more vacationing if they're really, active 85-year-olds. There's plenty of them out there. But isn't it better to have an extra $2 million at age 85 than to basically give it to the government? That's essentially the difference. So that's the goal, right? So now we've identified I always say, is the view worth the climb? Now we've identified the view. Well, hey, for all this work we're doing, all this climbing, we're going to get to a view of potentially $2 million more for us to spend or leave to our heirs just by doing things a little bit differently. So the first thing that we want to do differently is we want to take advantage of, let's go back up to the top here and find our Roth. All right, so we know everything that they have there. Oh, here, yeah, we use our buckets, right? So these are our taxable buckets. So this is anything that's not in an IRA, not in a traditional IRA, not in a Roth IRA, not in a 401k or other tax deferred or Roth retirement account. So this is anything you get 1099s on. And you get these every year for interest, capital gains, whether they're short-term gains or long-term gains. dividends, etc. So this is the taxable bucket. We're not talking about that today. We're talking about tax advantaged and tax-free, and we're going to start with Roth, because the goal is to identify how much money you can keep in each one of these buckets and fill the rest of it up over here. And that's how you balance your accounts to get to a lower, significantly lower, or maybe even zero tax. So the first tool we use is Roth. So there's two ways that we can get money to a Roth IRA or a Roth 401k. Let's first talk about the benefits. So now I'm going to bring us down here. I'm trying to pay attention not to cut things off. So I'm going to make this larger so you can see it. So the first benefit of a Roth IRA, Roth 401k is after-tax conversions or contributions grow tax-free. So the money has already been taxed. You either tax it at the time of a conversion, or you pay tax on it when you contribute to either the 401k or the IRA. So it's already been taxed. Now it grows tax-free in the Roth IRA or Roth 401k. Distributions are tax-free for you and for your heirs. People ask this all the time. Well, I get it that we won't pay tax on it, but what about our heirs? What about our kids? What about my nieces, nephews, my friends, anybody I want to pass it to? Also, no tax for the heirs. There are rules, limits, restrictions, and things to watch out for. Let's start with retirement plans. So let's make this a little larger. I have here retirement plans. If employer allows, more and more employers are allowing things like 401ks to have Roths, 403bs to have Roths, 457 plans can have Roths, but they don't have to. They can allow it, but they don't have to. But now I see more and more people having that option, and really it's unusual if they don't. Under the Secure 2.0, so Secure 2.0, which just came about this year, you can now do a simple, a SEP and a simple Roth IRA. That's really, really helpful. So there are plenty of people out there that don't want the complications of a 401k or a 403b plan. Very few people even know what a 457 plan is, but if they're small business owners, they can use a SEP or a simple. I would argue that it's just as easy to use a 401k as it is in a SEP, and you can put more money aside typically, but that's for you to decide. So let's talk about contribution limits. Let me touch on this. So Roth 401k and Roth 403bs under the Secure 2.0, now it allows for the employers to contribute to the Roth option. It used to be that you could contribute, if you had a Roth option, you could contribute 100% of your contribution into the Roth option, but your employer would have to contribute into the traditional side. Now the new Secure 2.0 says employer can also contribute to the Roth side. So that's good. Very, very few plans have been able to put that into place so far, but I'm sure that they will. There's also a requirement that catch-up contributions for higher earners, that's anyone making over $145,000, those catch-up contributions have to go into a Roth option of a 401k or other retirement plan. Now, what's the benefit of that? That means more employers are going to have to offer this, because if the IRS says, if you're going to have catch-up contributions for those folks over 50, right? So folks over 50, greater than 50. Is that right? And greater than $145,000 must go to the Roth option. That means if your employer doesn't have a Roth option, or if you're an employer and you don't have a Roth option and you want to offer catch-up contributions for your employees, your employees are going to want it, you're going to have to establish a Roth 401k. So that's good. So let's talk about contribution limits. So we got this handy dandy chart here. You can grab this chart right from our website. I'm just going to pull our website down here for you. Let me find my mouse. Can't pull it down. All right. Here's our website. So you go to education and resources here. You go to the Ed slot corner, or what I call the slot corner. It's a lot of information about me and Ed here. This section here, download free tax planning materials for 2023. You click here, you put your email address in, and you can download these tables that I'm going to show you. So let's bring this back up here. Use these resources. I have these tables up all the time, as do almost all of our team. So when we're talking about contribution levels, let's focus on it here. Let's talk about first 401ks and 403b plans. Here are the contribution levels for 2023. Your maximum contribution is $22,500 unless you're over 50, and then you can contribute another $7,500. That's for $30,000 in either traditional or Roth retirement plan, 403b, 401k, etc. So for 401k, actually just 401ks and 403bs, because the contribution levels are different. So for 2023, $22,500, $7,500. If you're another $7,500 catch up, if you're over 50, and remember, if you make more than $145,000 a year, now this must go into a Roth option. So you can put $30,000 a year into a Roth. And if your spouse also happens to have a Roth 401k option, then he or she can also contribute $30,000 for this year into the Roth. So that is the contribution limits for the 401ks and 403bs. Here's simple IRA contributions if you have a simple plan. For 2023, it's $15,500, and if you're over 50, it's a $3,500 catch-up contribution for a total of $19,000. That's for a simple. And do we have SEPs on here? SEP IRA, there it is. The SEP IRA contribution limit is 25% of up to a maximum $330,000 of compensation. SEPs are a little more confusing. Limited to a maximum annual contribution of $66,000. This limit also applies to KEOs and profit sharing plans. So folks, you might say, well, wait a minute, Mark, I could put the double amount than I could in more than double an amount what I could into a 401k. But if you're an employer and you have employees, you may or may not want to use a SEP because your matching amount, percentage amount has to be the same for the employees as well. So these can get very expensive. But if if it's just you or maybe you and your spouse, it might be a good option for you, especially now that there's a Roth option. So worth exploring. So talking about contributions, no income limitations with retirement plans other than what you just saw with the SEP IRA. Certainly with the 401k and 403b, no income limitations. So you don't get phased out like you do a Roth IRA. So this is great. You could earn $1 million to $3 million a year and still contribute to your Roth 401k and Roth 403b. So that's a real plus. So we're going to put a star here. So no contribution limits. Conversion options, very, very few. Certainly with 401k plans and 403b plans, still yet to be seen with SEPs and simples. That's a very new rule. So conversion options, sometimes retirement plans will let you convert those funds, but it's usually wrought with all kinds of trips and hazards. You can only do it once. They won't withhold funds. I've only seen very few cases where you can have a schedule of Roth conversions year over year. And that's what we want usually. We want to be able to, going back to, let's find our buckets. Here we go. Typically what we want is we want a schedule of planned Roth conversions year over year until we get to that magic dollar amount that we want. So the first, we want to focus on contributions. Can you contribute to a Roth 401k plan or a Roth 403b plan or a simple or a SEP or a Roth IRA? So can you get money into this bucket via contributions? If you can, that's great. You want to take advantage as much as you can. The second is conversions. And conversions is simply moving money from the tax-deferred bucket to the tax-free bucket. It's actually a distribution that's allowable to go right into the Roth IRA. And what you have to do is pay the tax along the way. All right, so let's zoom in again down here and see where we are. The 5-year rule. We're coming up on the 5-year rule. Watch out for the 5-year rule. The 5-year rule with retirement plans and IRAs say that if your contributions or conversions are not in the plan for at least 5 years, then anything, let me put it another way. You must have at least 5 years in the plan for distributions to be considered tax-free. So the growth will still continue to grow tax-free, but any distributions on that growth would be considered taxable if you're within the 5-year rule. Again, the 5-year rule is confusing. I could spend a lot of time on that. I'm not going to. Just know this. We have a whole other video on that as well. Just know this, that if you're under 59 and a half, there's a lot of things to pay attention to. If you're over 59 and a half, it gets very, very much easier. With your 401k plans and 403b plans and other retirement plans, watch your paycheck. Because if you suddenly shift all of your contributions to a Roth option in your retirement plan at work, then you're going to see less money in your paycheck. Why is that? Because you're now now you're paying tax on that money. If you contribute to a traditional 401k plan, $30,000, let's just say, you have less of an effect because the money is not taxed yet. You're going to pay that tax money later on. But as soon as you contribute the $30,000 into a Roth IRA, you have to pay tax on that $30,000. Where does that tax come from? Well, it usually comes out of your withholding and out of your paycheck, and or it should at that point. And you're going to see less money week over week or semi-monthly, however you get paid. So you may want to ease into it just to see the effect on your paycheck, because it's something many people don't think about. They say, wow, I started contributing to my Roth and I didn't realize how much it was going to drop my take home. So watch your paycheck. You just might want to ease into it. If 30,000 is your goal, you might want to do it in increments. Or if 10,000 is your goal, do it in increments. Okay, now let's talk about a Roth IRA. So that was retirement plans, right? Mostly 401ks and 403bs because they're the most popular. But let's talk about Roth IRAs. Well, there are contribution limits. Now let's go to the contribution limits. Again, the handy dandy green forms here. So with the contribution limits with an IRA, traditional IRA, or a Roth IRA in 2023, you can contribute $6,500. There is also a catch-up contribution. That can be that if you're over 50 and so 50 plus, and that can take you up to $7,500. Let's make this a little larger. So that doesn't sound too bad. You must have earned income to be able to contribute to a Roth IRA. There's things like that, but that's not too bad. But you get these phase out levels with an IRA for a married filing joint client person, 218,000. So this is your modified adjusted gross income. If your modified adjusted gross income is over $218,000, you start being able to contribute less to a Roth IRA. That's a phase out. Once you cross over $228,000, then you can't contribute anything to a Roth IRA, just the Roth IRA, not Roth 401ks and 403bs. Remember, there is no income phase outs for retirement plan Roth contributions. If you're a single filer or head of household, that phase out starts at $138,000 to $153,000. And then after that, you can't make any contributions. So that's something to pay attention to watch out for. Let's come back to our list. Conversion options. So we talked about contributions. Conversion options. How about anything goes? Here's the great thing about Roth IRAs and accepting conversions. The IRS says, do what you want. Convert $1,000, convert $1 million. We don't care. Convert it all at once, convert it over 10 years, convert it over 5 years, convert it over 20 years. We don't care. We just want our tax. That's what they want. You figure out how much tax you want to pay and do the conversion. So now you got to go to your handy dandy orange chart here and figure out your taxable income. And figure out if you're married filing jointly or if you're a single filer, and you figure out where you're going to land before conversions and where you're going to land after conversions, what your tax rate's going to be. And then you figure out how much tax you're willing to pay to get that money converted and what schedule makes sense for you. Everybody's different. But again, you want to go take it from this tax deferred bucket to the tax free or tax advantaged bucket, and usually not in 1 year, but usually over a schedule. And that is driven by many things. And certainly it's driven by where you're going to land with your tax rate. But that's it. Anything goes. It just depends on what's best for you. And I will say it again, that is an absolute gift from the IRS, because if we didn't have this anything goes approach from the IRS, it would be very, very hard to get people to zero or tax efficient. Now, how about the 5-year rule? 5-year rule exists for IRAs as well. Complicated, under 59.5, really, really simple, over 59.5. If you've had any Roth IRA for at least 5 years, any Roth IRA for at least 5 years, then any growth and any distribution of that growth is tax-free. So that's much simpler. Under 59.5, the rules are much more complex for retirement plans and IRAs. But again, we've got a whole video on that. Things to watch out for. Of course, your tax rate. You don't want to go too high. You know, we had people earlier in the year who said, and people get overzealous. I've seen this many, many times. Oh, I read about Roth conversions. I read about tax efficient planning. I jumped right in and converted $1 million last year. Wow, that's probably more than you needed to do. There are cases where that makes sense. But for your average person who's got, I'd say $1 to $3 million in their IRAs, that may not make sense. Even you're probably going up to even a $5 million level. That may not make sense. But so they're probably paying a higher tax than you need to. So watch out for that tax rate. Ideally, we want to go take it up to the top of the 22% bracket, and often and many times up to the top of the 24%. Sometimes it makes sense to go into the 32. You heard when David McKnight was sitting in the studio here with me on May 16th, I think he said 32% bracket is his least favorite, but hey, it's better than 40 to 45%, which is where we expect most people to be by 2030. So watch out for that tax rate. Watch out for tax credits. If you're expecting a tax credit and if you push your income too high, then you're going to lose that credit. So EV credits are a big thing. You can get up to $7,500. There's prohibitions on how much money you can earn now under the new Secure Act 2.0 to receive that EV credit. But there's other tax credits that you have to watch out for. Capital gains tax rate. You got to watch out for your capital gains tax rate. Yes, capital gains are calculated separately than those tax brackets, those marginal tax brackets, but we have to pay attention to it. Back to our orange. We're right here with our orange bracket. Here are our capital gains rates. You can be taxed. I'm right up here. You can be taxed at, I'm going to make this a little larger, this section, so you can see it. You can be taxed at 0, 15, or 20%. But those gradients of tax are based on your modified adjusted gross income. So you could easily go into 15 if you're doing Roth conversions. You could also easily go into 20 if you convert aggressively, if you have some income and you do some aggressive conversions. And it doesn't end at 0, 15, or 20 because you see these asterisks. There's a 3.8% Medicare surcharge for anybody earning over, it's usually in here. It's 250,000. I believe it's 250,000 for married, filing jointly, and I believe it's 200,000 for single filers, but we'll have to confirm that. But you've got to watch out for the 3.8% surcharge, because now 15% becomes 18.8 and 20 becomes 23.8. And that when you start hitting 23.8, that makes that capital gains tax less efficient, right? Because it's very close to this area here that what we're showing on the right. So you got to watch out on the effect of capital gains tax. You can usually manage capital gains tax unless you're in mutual funds, and it's much, much harder to manage those capital gains tax rates in mutual funds. But you can manage that from proper investment management. So IRMA, income related monthly adjustment amounts. I hear this from people all the time who try to do things on their own, and they say, I knew about Uncle Sam, but I didn't know about Aunt Irma, and this is costing me a lot of money. So you can go to our website and download the handy dandy Medicare income planning chart. That is a great chart, and you can see that for a married filing joint. I'm going to make this larger at $194,000. And again, that's based on modified adjusted gross income. There's no surcharges for Part B. So your total premium this year is $164.90 a month. Also, no surcharges on here. But once you cross over this cliff, and these are numbers if you're a single filer, right? So we'll use the single filing cliff for purposes here. Once you cross over $97,000 as a single filer, $97,001. Now you pay an extra $65.90 a month. So your total premium for Medicare Part B is $230.80 a month. And you can see the other surcharges. And so the total is $78.10. So we track this really closely for clients. But if you're trying to do this on your own, there's a 2-year look back. So that always hits people too, because they think everything's running really smoothly. And then suddenly they get a big IRMA reduction or payment due. All right. So that's IRMA. Watch out for IRMA. Too much. You can convert too much. We talked about that. Be careful. Sometimes people just want to hit the gas. You can convert too much. You can convert money that never needs to be converted. Paying tax on money that you're never going to pay tax on over your lifetime, during your lifetime, or even what you leave to heirs is the first thing you want to avoid. You can also convert too little. It can take you too long, and too little opens you up to tax rate risk. And because the longer it takes to convert, the longer you have this tax rate risk. Again, we think the taxes are likely to get somewhere, begin doubling or start or get near double by about 2030. But that is a moving target, folks. So if you're looking at this 2 years from now, it might be completely different. I'm sure it will be. And of course, we talked about the 5-year rule, but I got to hear it again. So watch the 5-year rule. All right. So that was longer than 15 minutes, but that was our Financial 15. Just part 1. You can see why I broke this down. Hopefully that was helpful. I know it was a lot of information. Again, our goal, where'd my buckets go? There we are. I'm zooming you folks all over the place. Our goal is to balance these buckets, have the mathematically ideal amount in this bucket, have the mathematically ideal amount in this bucket, and have everything else over to this tax efficient bucket. The only thing truly tax-free is Roth IRAs and properly structured cash value life insurance, or as some people call them, life insurance retirement plans. And we're going to talk about those later. But if you get everything balanced, you can achieve possibly the 0%. That's $0. We want 0% tax bracket, or minimize your taxes substantially. And that, of course, is the goal. Step 1 is looking at Roth contributions and Roth conversions. And I think we covered just about everything in that step today. If you have any questions, reach out to us, and let's see if this will work. Well, if you reach out to us at questions@attleboroughwealth.com, questions@attleboroughwealth.com. If you want to schedule time with us, you can reach out to us also at questions@attleboroughwealth.com. And I'd love it if you reviewed our website, and you can find it at, of course, attleboroughwealth.com. Give me your thoughts about it. It's a new site. I'm excited about it. We keep adding things still to be added, our events page. And there's something else too. I can't think about it, but we're at 11:04. So I'm going to let you folks go. I hope you have a great week, and I'm looking forward to seeing you all next week. All right. Take care, everybody.